All right, here we go. Welcome back, everyone. I'm Rich Curtis with EXP Realty, and today we are going to be going over a market update specifically for El Dorado County. We'll do Sacramento and Placer in the future, and we're going to be going over interest rates, where they are now, where we think they're going, and how you, as a layperson, can interpret those rates without learning to read financial charts and having to get a business degree. I've got Dave Miller with me today. He's a lender I've been working with, well, as of January, for 20 years now. He's my trusted and preferred lender, and he's going to be our interpreter for all things interest rates and where that's going today. Thanks for coming and joining us today, Dave.
Thanks for having me, Rich. Looking forward to it.
All right, we're going to try to keep this quick for you. We're going to jump right into the numbers for El Dorado County. Now, when I look at these numbers, one thing for you to note is that the numbers in El Dorado County are going to maybe look a little higher than what you're used to. So say you're looking at Placerville and you're thinking about moving to Placerville. Well, when you look at these numbers that I'm going to show you today, they're going to look a little high because, of course, the median price in Placerville today is around 500 grand and about 535 average. So when I show you the numbers for El Dorado County, they're going to look really high. But remember, at the eastern edge of our county, we have South Lake Tahoe, which is going to average around 700 grand. And then at the western edge of our county, we have El Dorado Hills, which is going to average nearly $1 million in the high 900s. So that skews our numbers. So if you're looking at Placerville or you're looking at Pollock Pines and you're thinking the numbers I'm showing you today look crazy, oh my God, I can't relocate there. Don't stress. Placerville is still a median of 500 grand. Pollock Pines still a median of the high 300s, 385 or so. So there's still great bargains to be had in pockets of El Dorado County, but this gives you the 30,000 foot view numbers across the whole county. All right, we're going to start with our days on market graph here, and that is going to give you a sense of how long it's taking to sell homes in El Dorado County. But the graph's not coming up. Why is that not opening? There we go. All right, guys, here's our graph for days on market for El Dorado County, starting in January of this year and going through September of this year. So, of course, this isn't a complete year data set. Now, you'll notice this sort of U shape to the graph, and I'm going to show you the last 3 years, including this year, of graphs, and you'll see this U shape being consistent. So these are kind of seasonal known fluctuations. What we want to focus on is where we're getting to and what the actual numbers are. So at a low this year, we hit a bottom of 39 days on market, and that was in June. That's in our hot summer market. And right now in September, we haven't reported October numbers. Obviously, we're right about 55 days on market. Now, to put that in perspective, if we grab January of 23 to January of 24, and we'll throw that up on the screen, right around this time of year, we were at 38 days on market. So 1 year ago, we had 38 days on market. You can still see that U shape again. Those are just seasonal trends. Don't focus on that. So we're at 38, and today we're at 55. It's a pretty big difference. If we go just one more year back, we can look at January of 22 to January of 23. And you will see we actually had in September 47 days on market. So we're still sitting just about 10 days on market higher. That doesn't sound like a lot, but when it comes to the amount of time that someone has to wait to sell their house and the buyer's perception in the marketplace, that makes a real difference. And we are seeing that trend continue to tick up. And that's an indication of a softening of the market. And we'll go through that more as we look at our other graphs. So let's grab inventory. When we talk about inventory, what I mean by inventory is at the rate I'm selling houses today, not just me personally, wish I was selling all of them, but I'm not. But at the rate we're all selling houses today, if no more houses hit the market, I'd be out of houses to sell in that many months. So if I say 3 months of inventory, then from the date of today, if no more houses listed in 3 months, I'd be out of houses to sell. That's what inventory means. And it's an indication of the strength of the market. It's an indication of who has an advantage in the market, buyer or seller. So if we look at this graph here, the left edge being January of this year and the right edge being just last month, September of this year, you can see we started right about 3 months of inventory. We hit a low of 2.3 months of inventory. And right now we're sitting at 4.3 months of inventory. Now, why this is significant is because a seller's market is 2 months or less of inventory, and a stable market is 3 to 6 months of inventory, and an advantage to a buyer. A buyer's market is 6 months or more of inventory. And you can see for most of the year, we've been below that 4-month mark. We've been still in seller's market territory, but softening. But just now we're ticking up to 4.3 months of inventory, which is a real high point in the last 3 years. We've been suffering from low inventory all the way from COVID till now. Lots of reasons for that. There's a lock-in effect on the loans where everybody doesn't want to give up their low interest rates for higher interest rates. And there's also just that our building of homes isn't keeping up with family formations. And so we have a strong buyer pool and not enough houses to sell them. And that's been keeping our inventory low. But just now we can see we're getting up to a little bit more inventory. That is getting into neutral market territory, which is someplace we haven't been since before the pandemic. It's kind of funny how all parents set everything in their life from the date of the birth of their kids, and they reference that. And now I feel like in business and everything else in life, we reference from the pandemic to now. But this is the highest point in inventory we've seen since the pandemic, and that is cooling the market off and taking the pressure off buyers a little bit. If we look at this compared to a couple of years past, last year, January 23 till January of this year, you can see we have a lot more twos on the board here, 2.5, 2.3, all the way down to the low of 1.9 months of inventory. At the height of the COVID market insanity, Dave and I have been working together 20 years, like I told you, and we've been in every market from the Great Recession to the COVID market nuttiness and everything in between. At the height of that COVID insanity, we were seeing sub 1 month of inventory in most of our markets here, which is what made it such a strong seller's market. So you can see just 1 year ago, we had nothing approaching a 4. We had a high of 3.9 in January, and that's because of the flood of new listings that come on in January. But for most of the year, we were below 3 months of inventory, finishing up at just 3.1. Now, if we go back just one more year, this is our January 22 to January 23 graph. And we finished up, we started the year again in January with that 3.9, but most of the year you can see 1.6, 1.7, 1.4, 1.8. And then we just started getting up into the twos. So you can see we've gone from January of 22 till today from 1.6 months of inventory to 4 months of inventory. We've almost quadrupled the amount of inventory on the market. That is good for our buyers. It's eased the market. It's made things a little less crazy out there. All right. Now, what everybody really wants to talk about is prices. And again, these are average prices for the whole county, not for specific places. So they're going to look a little high depending on where you're coming from. Here is our January 24 to September 24 price graph. Now, don't look at the green line. Those are the for sale prices. These are wishes, hopes, and dreams. The red line is what people actually are selling houses for, starting in January at 689 and finishing up last month at 725. Now, this equates to a year-over-year appreciation of about 5%. So 5% over the last year we've gained in property values in El Dorado County. That's significant for two reasons. One, Lawrence Yun, the chief economist at the National Association of Realtors, has predicted that we're going to see 15 to 25% appreciation over the next 5 years. If you take the low end of that use case at 15%, over 5 years, that gets you 3%, which is about our average appreciation nationally over the last several decades. We have outpaced that already, doing 5% in the last year. That gives you an indication that his predictions, at least for now, are right. Of course, there's lots of variables in the economy that can change, but it shows you house prices are still staying strong, even in light of the high interest rates, which Dave's going to get to in a minute. And they're staying strong because of the last graphs I went over, because of that low inventory. Now, if we go to just last year, January 23 to January 24, you can see today we were at 725 average price. We were finished up the year at 689, right where we started. And we had started the year at 699. So we did have a slight loss last year, and that is due to the pressure that the interest rates put on the housing market, the downward pressure. We saw about a 1.4, 1.5% reduction in housing prices in El Dorado County that year. Now, the reason for that is on this final graph, which is going to be January 22 to January 23. You might remember the major inflection point D-Day in our industry in real estate was around July in the summer of 2022 when they doubled the interest rate. So on this graph, you can see we were up around 765 in July of 22. We went down and then way down all the way to 618. We finished up the year at 699 and we started the year at 696. And so that looks like, relatively speaking, a flat year. It equated to about a 0.4% increase. That was only due to how massively homes had appreciated early in the year. We fell dramatically. We just had a lot of freeboard to work with that year. This was the reason. It was the interest rate change here in the July timeframe that caused that. But you can see overall, even with those interest rate reductions, we have still seen some positive upward pressure on prices, and that is due to the inventory. So that is the state of our market as it sits right now. I'm going to put it over to Dave to talk a little bit about where we're at, interest rates, where we've come from, and where we're going.
Perfect. Thanks, Rich. Happy to talk about rates here and piggyback on a couple things that you said. And I think a couple things is with the fluctuation in inventory and interest rates really has an impact on buyers' ability to buy, the buyer pool. And, you talked about the a normalization in the market or becoming, an equal market. So not necessarily a seller's market specifically, but opening up the opportunity for seller concessions and folks that aren't just cash buyers, folks that, need to get a loan, have an interest rate, and maybe they don't have a full 20% down or aren't just competing with cash buyers anymore. So, I see a lot of positive things in the market by this happening for the buyers. And now what we want to talk about is how interest rates affect those buyers. So I'm going to share a graph with you here, and let me share my screen. And so what we're going to look at here is, let's see here. Let's go. That's not what I wanted to see. There we go. You should be now looking at another chart.
There we go.
Okay. And so what we're looking here is the 30-year mortgage-backed security chart. This is what I look at all day, every day. Really affects interest rates, not only on a daily basis, but what we're going to talk about a little bit is how rates change based on when the Federal Reserve changes the Fed funds rate. So what I did here, Rich, is if you look at these green candlesticks here, anytime that this mortgage-backed security increases in value, that is good for interest rates. Okay, or excuse me, it's bad for interest rates. The red stick here means that interest rates are getting worse. Green means they're getting better. I said that incorrectly. So the higher we are on the chart here, the better we are for interest rates, mortgage interest rates. And if you can see this red box here, what this represents here is September 18th. And what's significant about that day, that's the date that the Feds came out and they lowered the interest rates by 0.5%. And so you as the consumer, that didn't necessarily equate to 0.5% lower in mortgage rates. But you see, if we go back to the left of that red box here, you could see gradually back from July 29th, which you could see to the left, interest rates were gradually improving. The Feds lowered rates, that was already baked in. And so at this point in time, we were seeing rates in the low 6% range at the height when they lowered the interest rates. And they stayed that way. And even, we even saw them touch the high fives for a minute. Then as you move all the way to the right on the chart, all the way at the end, that's where we're at today. And so you could see we've decreased, nearly 200 basis points. That might have an effect on interest rates of close to 0.5% in interest rate. But as you can see, there's slow movement throughout each day, and some days may have some bigger movement. So as a consumer, where interest rates are is really important to you, but there's always going to be a window of time when you're looking to buy a home. And so, Rich, we talk about this all the time. When you want to get pre-approved for an interest rate, you want to know where rates are at now. And everyone asks me, well, is now a good time to buy? Where are rates going? My feeling is that over time, we will see an additional improvement in rates, but what that means for a consumer that's ready to buy a house, we don't know if we'll see rate improvements during that window of time that you're looking to buy. So right now we're in, a low to mid 6 interest rate based on down payment and credit score, which historically is a really good rate. And so we talk about if you're comfortable buying a home, and as we go through the pre-approval, pre-qualifying process, we talk about all the things that really determine whether, or help you determine whether you're in a position to buy our home or not. And so when I'm going to quote you an interest rate, I'm typically going to quote you an interest rate, not the best rate for the last 3 months or where I think rates are going to be, if they're going to be better. I'm going to tell you within a range of where rates are today and prepare you for, if you're ready to buy, how that affects your payment. If it takes you 30, 60, 90 days, 6 months to find a house that you like and you're ready to buy, if rates were to move within, say a 0.5 percentage point, how much that actually affects your payment. And traditionally, it's not a ton per every eighth in interest rate. It's on average, it's probably going to move your payment $40 a month. So, a quarter point, you might, higher, you might pay $80 more a month.
And that's on, say, a $500,000 loan?
Yeah, that's about right, Rich. That's on a $500,000 loan. And once we identify your kind of comfort level for purchase price and payment, then when you're ready to go out shopping for homes, I typically will give the buyer a range that says, okay, if I spend $50,000 more for this house and have to borrow $50,000 more per 10,000, how much does that affect my payment? And what's going to happen if I am looking for a house and I don't, I find one 3 weeks later, I put an offer in and rates are a quarter point higher. How does that affect my payment? And so you're already prepared with that. And so, when we talk about, Rich, too, is it's really difficult to time this perfectly. If you see all these green and red candlesticks on this chart, rates can change a little bit every day. Back before the Great Recession, I used to be able to predict, the amount that interest rates would move or when they would move, 30 days out. But anymore, overnight, you could see rate changes or the cost to get that rate change just based on any news that comes out or economic data. So that's another segue. And go ahead, Rich. We had a question there.
Oh yeah, and I think that's such a great point, that part of being an educated home buyer and something that people don't know up front when they come to you or me is how volatile and variable this is. They'll see rates quoted on the TV or on the internet, and they'll think, well, that is what it is. But we're always working within a range, which is why it's so important to have a valued lender partner involved early in the process. If you've watched any of the videos on the channel where I talk about your first steps to buying a home and walk you through that process, step one is contact me and then ask me, or if you're in a market that's not my market, another trusted realtor of your choice, but ask them instantly for a referral to a trusted lender and get that lender involved right away, because he's going to be, or she is going to be able to give you a price estimate at both ends of the range. Right now we're bouncing between, whatever, 6.5, 6.8, whatever it is. So if you're at the low end, here's your payment. If you're at the high end, here's your payment. And if you're comfortable at either end of that, let's go shopping and not worry about it. And if you're not comfortable at either end of that, then we maybe need to sit back and reassess. And it's one of the reasons it's important to have trusted advisors and people who are willing to say to you, maybe now's not the right time for you. Every buyer consultation for us isn't always a success where we run right out and get in the car and buy a property. It might just be a chance to help somebody on the next step on the path. And that might be increasing income, increasing savings, decreasing debt, getting to the point where you're going to be comfortable at either end of that range so you can shop without worry. So interest rate isn't this sort of fixed, what you're getting right up front kind of thing. We always have to counsel people and quote them within a range.
Yeah, you bring up a really good point there, Rich, is it's always a range. And the day you start looking at for a house isn't necessarily the day you could lock in an interest rate. And so, there's a lot of economic factors that go into interest rates. And, we talk about when, the Feds lower interest rates and when we expect them to lower again. It's not a one-to-one. If the Feds say they're going to lower a quarter, a half a point, that's not a direct necessarily impact on mortgage rates. So when they lowered rates 0.5%, we didn't see mortgage rates just drop 0.5%. As you see on the chart in front of you, that was kind of baked in.
Yeah. And so what Dave's talking about is those green bars on the left side of the screen leading up to that red box where they lowered the interest rate. the Fed had already sort of telegraphed what they were going to do, right? They'd already told people we're going to do a quarter. Now we're reconsidering we might do a half. And because we're a confidence-based market and it's not directly tied to this, it's not that one-to-one, the market is making a decision based on what the Fed's saying, and they're already kind of baking that into the cake. And that's why we don't see that instant drop when the Fed drops a rate on that day. Can you talk a little bit about sort of what happened in the immediate aftermath? And, with rates going down and touching the high fives, but why we didn't keep going down? What happened there?
Yeah, and so that's a good point, Rich. Is so if you look at the highest point of that chart, and we were at 101.5 on the chart. What happened is the economy, ended up chugging along a little stronger than they expected. So if you fast forward to this, about from that square red box, go all the way over to the next largest red drop on the chart there, what happened is the jobs report came out, and we had created way more jobs than they expected. So unemployment figures, and what that does has a direct effect on inflation, and the CPI number came out. And so what happens is there's economic data that's coming out weekly. And so, that data usually has, mild, moderate, or high impact on what it's going to do to interest rates. And that's not necessarily for the long term, but for the day or for the week. And so there's constantly, it's not like this happens, once every 6 months or once a year. There's constantly economic data that's coming out that's going to affect the interest rates. And so, we had, better than expected numbers coming out, and that's why interest rates kind of shot back up a little bit there. But again, this is what I pay attention to all day, every day. I share this information with Rich, but as a buyer, you want to work with someone, a lender that understands this, is paying attention to it. And you shouldn't worry every day about what's going on with interest, with the economic data that's affecting the interest rates. Leave that up to someone like myself to have that conversation with you. Pay attention. And then once you're in that window, once you've you've made an offer on a house, and we're ready to lock in a rate, then we talk through timing of locking in that interest rate and what economic data is coming out in the next days that might affect that interest rate.
Yeah, and I think that's a great point. We can go deep on this is what we do for a living. We've been doing this 20 years. Dave's going to have this chart up. He's going to be looking at the CPI numbers. He's going to be looking at the unemployment numbers. He's going to be looking at the housing starts. He's going to be going granular into all these things to try to be informed and read the tea leaves the best we can, especially given all the new volatility in the market. And none of that's tenable for you as a consumer to do. So what we try to do on this channel is help you make the highest quality real estate decisions you can from the comfort of your couch. And to do that, you need to know, how can you interpret this? How can we look at this? And so for me, I am watching from the 30,000 foot view what the Fed is saying and what the Fed is telegraphing. And unfortunately, when it comes to interest rates, bad news for the economy is good news for mortgage interest rates, and good news for the economy is bad news for mortgage interest rates. But Dave, can you speak on a little bit of that confidence piece where if Powell comes out and says X, then the market is going to just respond to what he said in this way. And if he says Y, it's going to respond this way.
Yeah, that's a good point. And everybody hears that, the Fed speak and that they're going to come out and speak. And that, again, I already said this, but a lot of what he's going to say is already baked in. They kind of anticipate. So we're already anticipating when they lowered interest rates 0.5%. We've also heard that, throughout the remainder of the year, they're going to lower 2 more times at 0.25 point each. Well, then the economy, got a little bit stronger. So we may not see those 0.25% decreases. But again, those 0.25% decreases don't necessarily equate to better mortgage interest rates. So again, I know there's a lot of dialogue that goes on out there that's talking about, and the news will publish, oh shoot, inflation is doing this or unemployment's or that. We pay attention to that, but we're also going to really boil it down to how this affects you as a home buyer in that window of time that you're looking to buy a house.
And the news does a really bad job of making it seem like, and so let's like put a pin in this for everybody. They make it seem like the Fed's dropping a half a point, and we kind of said this earlier, but I want to make this really clear. The news makes it feel like, well, they dropped a half a point, so run out to your mortgage broker because you just got a half a point off your mortgage, or go refi, and that's not how it works at all.
That is correct. And so, and as I mentioned, I've shared with you a lot of times too, is when good economic data comes out that's going to or the data that's going to improve our mortgage rates, they tend to improve slower than they get worse. And so, and that's just always been the nature of the business. So if, some great news says, okay, mortgage rates are going to go up quite a bit, they go up really fast. And then when we get the data that says mortgage rates are going to improve, they improve really slowly. And that has to do with the investors and the servicers that hold those mortgage-backed securities, just how they, roll out interest rates, because they don't want to be stuck with something if there's going to be a quick swing on a 30-year coupon that they're stuck holding.
Yeah, absolutely. And so when we look at these numbers and we look at what happened with that last Fed announcement, it was already kind of baked into the cake. They're going to do 0.25%. Then they really sort of early on, I think they jumped the shark in saying they were going to, do a 0.5%. And so the industry baked that into the cake. And then immediately after that, we got economic data that said, oops, sorry, we're all doing really good. We just added a bunch of jobs. Things got better. And that was that right hand side of the graph where you saw the interest rates getting worse. Now, the Fed, as far as what I'm hearing, is kind of telegraphing that they might have gone too far too soon, and they might not do a reduction at their next meeting or even the one after that. We might be looking at 1 to 2 cycles of stability. They're not saying they're going to worsen the rate, but it's not looking like they're going to make the rate better. So in your opinion, with the rates where they are now and people sort of baking that information into the cake, what do you think this looks like, 3 months, 6 months, 8 months out on interest rates?
Yeah. And when I go out, I typically go out 1 to 3 months. And I would say we're going to stay within this range for the next 3 months. And once we go out beyond 3 months, my gut feeling, or my feeling based on the data that I'm seeing, everything points to rates probably coming down a little bit more. Fannie Mae, Freddie Mac have all come out and they have their projections of where they think rates are going to be in 2025. All of those point to a lower interest rate, but that's the beauty about our business. And when we look at, when you buy a home and you buy a home today and you get a 30-year interest rate, that principal and interest payment will not go up for the life of that loan. But if rates improve, you have the opportunity to refinance and lower your rate. So it's kind of like the best of both worlds there. And so what, Rich, you and I always talk to a buyer about, if you're going to buy a house and you have a $500,000 mortgage, are you comfortable with that payment today? And where rates are today, because we cannot project the future, is you'll have an opportunity potentially at some point in time to lower that and just lower your monthly payment. But knowing what you have is guaranteed.
Well, that's a great segue into how do I take all this information that's flying at me and what do I do with it, right? So now we've sort of told you that if the Fed says they're dropping by this much, that's not a 1-to-1. It's more important what they say they're going to do next than what they say they're going to do or what they just did. So if the Fed signals they're going to drop more in the future, rates will probably get better. If the Fed signals it's going to be stable, it'll be stable with its normal daily volatility. And if the Fed signals, hey, we messed up and we might have to go up again, which let's all hope that doesn't happen.
Right.
I don't see that happening. Then rates will worsen sort of instantaneously in response to that confidence. So if you're sitting at home and you're just watching the Fed announcements, you can kind of get a sense of where things are going yourself, just like that. But what does this mean in terms of who should buy and who shouldn't? So we know right now we're in that, 6 to 6.5, Dave? Is that where we're at?
Yeah, that's correct.
So we're in that 6 to 6.5 right now interest rate environment. We know that's going to stay for probably at least 1 to 3 months. And, if it comes down, it's only going to come down a tick. We're not going to see dramatic swings. So the interest rates are what they are. So is that a reasonable criteria for making a purchasing decision? And in my opinion, after doing this for 20 years, the answer is no. You make your purchasing decision whether you can afford to buy a home right now at this interest rate period, not what the rates are going to do and not what they've been in the past. So when someone calls me or Dave and says, hey, is now a good time to buy or is now a good time to sell? If anybody you call says, yeah, it's a great time, let's get in the car, let's go, then you need to hang up and call somebody else. There's a whole series of questions we need to ask next, because it's not whether it's a good time to buy now, it's whether it's a good time to buy for you. So those criteria look like, do you have stable employment? We have some volatility in the jobs market, although the numbers were really good just now. But if the Fed were to start to, continue to contract and to tighten and raise rates, we could see more job loss. And so do you have stable employment in a relatively recession-proof industry? If you're, a nurse, you're probably okay. If you're installing high-end fake lawns on mansions, could be some tough times ahead. So what industry are you in? Do you have an emergency fund? Do you have a 6-month emergency fund where if you did have some job loss, you had to look for a job for 2 to 3 months, could you still make the mortgage payment, right? Can you afford this payment at this rate no matter what? Could get better. We think it's going to get better. If it gets better, you win. If it doesn't get better, are you still okay? If this mortgage interest rate and this mortgage payment for the home of choice you want puts you under pressure right now, you're not the kind of person who should be buying a house right now. And if you're selling and going to buy up, in that buy up process, same thing. If it puts you under too much pressure, you shouldn't buy right now. So we can't base our decisions based on the rate. We have to base our decisions on, are we a qualified buyer for these other reasons? Because if all those other things are in place, if you have stable employment, if you have an emergency fund, and if you can afford this payment no matter what, then great. You get a great house right now before prices go up. As we talked about, we saw 5% increase in Dorado County in the last year. And we may have mentioned before, maybe we didn't, that Lawrence Yun, the chief economist of the National Association of Realtors, thinks we're going to do that, 15 to 25% over the next 5 years. You're going to lose way more as the house gets up in value than you're going to lose on the differential in the payment. On a $500,000 house, the difference between a 5.5% and a 7% interest rate is going to cost you maybe $4,000 over 2 years. If you're doing that kind of appreciation over that 5-year term on a $500,000 house, at the low end, you're going to get $82,000 in appreciation. It really quickly outstrips the amount of money you're spending on the interest rate. So we should be less rate focused and more, can you afford it focused? If it is something you can afford, you should be buying right now in this environment. And if it isn't, you shouldn't. And you want to work with trusted advisors who are going to be honest with you and say, hey, when someone complains to me about the $100 difference in fees on a real estate transaction, or a quarter to a half a point, I have to step back and say, look, if that really dramatically is affecting your family, let's not do this. Let's pause.
That's a very good point, Rich. And the other part of that is, what's your alternative? Are you renting? We spend a lot of time, really pre-qualifying, pre-vetting buyers to make sure they're in a good position to buy. How is this going to impact? But we go really deep into this and really understand your financial situation. Again, to what Rich was talking about, what's your employment look like? What's your future employment look like? Are you in a job where, that every year for the next, 5 years, you're going to get a 2 or 3 or 5% pay increase? Well, if that's the case, your mortgage isn't going to go up 2, 3, or 5% if you have a 30-year loan. So it might be a little bit tight today, but how is it going to be a year from now? Or, so those are the conversations that we have and understand. And again, making sure that, based on what the market's doing, real estate market, in terms of being able to potentially get some concessions and not use every last nickel you have to buy the house. We don't want to put you in that stressful situation either. So we'll really uncover, what's the right amount for down payment? How much should you have in reserves? What's your comfort level going to be? If you are planning on making a job change, how long can you go? All those things we will really dig into.
Yeah, and if you want to go even deeper on this, there's a video on the channel that's from a few months ago, says, should I buy now or wait? And it kind of goes through all these criteria for you to self-vet and self-assess whether you're the type of person who should buy now or not. One of the sort of snappy aphorisms kicked around in the lending and the real estate industry, especially over the last couple of years in the high interest rate environment, has been this sort of marry the house, date the rate business, which I'm not a big fan of saying that. The idea there is, buy the house you want right now. It doesn't matter what the interest rate is, because in the future it'll go down and you can refinance. Now, on the basis of it, they're probably right. Dave and I would both agree. We think eventually these interest rates are coming down. Do I think we're going to see 2.5% again? I don't, at least not in anywhere in a reasonable amount of time for anybody. But are we going to get into the low fives? I think we probably will. But even if we do, that doesn't mean you will qualify at that time. That's where these other qualifying questions, are you going to retire? Are you retiring next year? Well, now your income just went down. You're on a fixed income. Will you qualify for a refinance? Are you going to have to move suddenly because you have elderly relatives across the country that you need to go and take care of? You can see their health is failing. You know this is in the offing, so you're going to have to sell in a couple of years or try to rent, or you might have to give up your income. I just had a client who had to retire early to take care of elderly parents. Now he doesn't have an income. Interest rates drop. He can't refinance based on his fixed income, his Social Security, right? You may lose a job. You may get your hours reduced. Not everybody gets fired in a recession, but a lot of people get their hours reduced. There's a lot of things, a million variables we deal with all the time. You might make some bad choices and go buy a yacht or a motorcycle or a new power boat for the lake. And now you're not in a credit situation to refinance that loan. And if you're not, this whole marry the house, date the rate business doesn't apply to you. And that's why fundamentally, if you can't afford it now, you shouldn't buy it. We can't make real estate purchases planning to be able to afford it in the future.
Yeah, Rich, you bring up a really good point. And as you mentioned, we've been working together 20 years, been in this industry for 20 plus. And I've heard a lot of agents, both real estate and mortgage professionals, say to clients, oh, just buy it today. It'll be tight, but refinance in a year or 2 years down the road, rates will be a point lower and you're going to save $600, $700, $800 a month on your payment. Well, there's no guarantee. There's a lot of things that have to transpire for you to qualify to refinance down the road. Typically, most folks can, but there's a lot of factors. What happens if the value drops and you don't have the equity in your house anymore? Well, then it's harder to refinance. Like you said, job change or whatever happens in life. So we always talk about, are you comfortable with the payment today? And if this is how it was locked in, and we also talk about, your increase in your income. So most people's income will increase over time. But typically your mortgage will stay the same. It'll stay fixed. And so you can make those decisions based on today and down the road. And it's bonus if we can refinance.
Yeah, exactly. So to wrap this up from the 30,000 foot view, right now, the real estate mechanics are good. Prices are set to increase. We're seeing data on the graphs we showed you that they are increasing. Real estate over the course of your lifetime is an absolutely great investment. And most of the millionaires in our country have gotten there through real estate investments. If you've been watching the channel a while, you know that I'm passionate about real estate because real estate built the middle class. It's often the first rung on the ladder out of poverty for families. It has financed more first generation college graduates than any other investment class in our country. People pulling money out of their houses, finances, college, just as much as 529s because people often start that savings late. Real estate, the fundamentals and the mechanics are great. It is a good time to buy. It is a good time to sell and buy up. But whether it's a good time for you, that is something you can only vet by getting on the phone with a trusted professional. If you're in our market, Sacramento, Placer, El Dorado, Amador counties, reach out to me via the contact information on the screen or in the description down below. I can connect you to Dave. We can help you make some good choices. If you're in another market, reach out. We can refer you to some good people there. If you have a trusted professional already, the key to winning at real estate is getting a trusted realtor and a trusted lender involved in your thinking, in your process as early as possible. We'll keep giving you information here on the channel to help you make those decisions, like I said, from the comfort of your couch. If you like this content and you want to see more, Dave and I are talking about doing this on a regular weekly basis. Let us know in the comments down below where you're watching from and whether you'd like to see some weekly updates. We'll throw in some Sacramento and Placer numbers as well for you. As always, thanks for watching. Thanks for making it to the end with us. We'll see you on the next one. I'm Rich Curtis.
I'm Dave Miller. Thanks, Rich.
Thanks for your time, guys.